All right, so today I am joined by Tim Kelly with Highlands Residential Mortgage. Tim is fielding a lot of the mortgage questions that I'm getting, and I just throw them right on over to him. So we figured that it would be a good idea to get together on video, address some of the most common questions that we're both getting right now, talk about forbearance, its impact on individuals, its impact on the mortgage industry as a whole, and just kind of the health of the real estate market overall. So good morning, Tim.
Good morning.
How are you?
I'm doing well. How are you?
I'm good. All right.
Great.
So, health of the mortgage industry, what forbearance is doing, what forbearance is, just the basic process that is going to be happening, and what the domino effects are to the real estate industry as a whole. That is a loaded topic. But to kind of start, could you just explain to people what forbearance is?
Sure. So, forbearance is not forgiveness. So when you are calling your servicer and requesting a forbearance, you're not being forgiven of that mortgage payment. What you're doing is delaying that mortgage payment. So currently, as earlier this week, it's being reported that about 7% of all mortgages across the country are in forbearance at this time. And that number, it was expected to peak today as people were having to make their May mortgage payment. So it could be as high as 10% of all mortgage loans. And that's through conventional financing, FHA, VA, USDA. And under the CARES Act, which was passed earlier, they are allowing up to a 12-month forbearance period. And so you typically call your servicer, say that you've been negatively impacted by the coronavirus and you're requesting a forbearance, and they have to agree to those terms. The great news that came out earlier this week that had a lot of people concerned is that they do not require a lump sum payment on the forbearance loans. So you are able to negotiate with your servicer and have those payments spread out or have them tacked on to the end of the mortgage. But make no mistake about it, a forbearance is not forgiven. A forbearance is just delaying those payments. Now, the unknown factors with forbearance is how that's going to impact the homeowner and their ability to get a loan in the future, whether that's to refinance later or to buy a home. And there is, I've done some research this week, and I can't find anything that is very clear on how the forbearance is going to be handled. It's not going to negatively impact your credit score or your credit report, but if we're looking to get a loan from a mortgage bank or a bank that's a mortgage loan, they have the right to determine how they want to handle that forbearance. And right now, it appears that someone who is in forbearance or has requested a forbearance is not going to be able to obtain a new mortgage that's a refinance or purchase for 12 months until they have made 12 months consecutive payments on time and paid back the forbearance. So as we get more information about this forbearance, it's literally coming out day to day. I'll be sure to share it with you, Danielle, so you can pass it on to your database.
Okay. So obviously that is a safeguard from people potentially abusing forbearance, because obviously this was supposed to be saved for people who actually needed it. And correct me if I'm wrong, but the original projections on the percentage of people with loans that they were expecting to actually apply for forbearance or use, this forbearance was originally supposed to be a lot lower than 7%, right?
Yeah, well, I mean, there's mixed, information that I've found there. I mean, earlier on, when they announced the CARES Act, and the issue that servicers have with this CARES Act is because it requires no evidence that you have been negatively impacted by the coronavirus. You can simply just say it, and we have to move forward. Whereas back when we go to 2008 and the housing crisis, you had to prove hardship. There's no requirement here under CARES Act. So there are people who may be taking advantage of it. And the estimates I read earlier on in this process, it could be up to 25% of all homeowners. And so I think right where we are, the 7 to 10% is kind of what was expected.
Okay.
Now, we can talk about, the health of the mortgage industry right now, where we're getting onto this subject and the amount of people who are requesting forbearance, because it does have a negative impact on the mortgage industry. And when we talk about the health of the mortgage industry, it's important to kind of understand how a mortgage works. So I just want to take, 30, 60 seconds to kind of just give a brief summary of how this works. And then you'll probably understand why forbearance is having the impact it's having on the mortgage industry. So simply put, you want to go buy a house, you want to go refinance a house, you go to a loan originator, they give you the loan. That loan is then transferred to a servicer, but the servicer does not own that loan. They're simply just collecting the monthly payments and maintaining the loan. They are paying out the principal and interest portion of the payment to the investors. They're paying out the real estate taxes to the counties where the taxes are due. They're paying out the insurance to the insurance companies. They're basically maintaining the loan for the investment bankers and collecting the payments. Now, the investment bankers take that mortgage and they securitize it and as a mortgage-backed securities, and that's traded on Wall Street. And those securities are often in your mutual funds and other investments. So the dilemma becomes, when people are not making their mortgage payment, it's still on the servicers to continue to pay those principal and interest payments, real estate taxes, and insurance payments, even though they're not collecting any monthly payments. Now, if you can imagine, if you have 7 or 10% of all homeowners stop making their mortgage payments for 3 months, 6 months, or possibly even longer, that's going to have cause a liquidity issue with those mortgage banks and servicers. And it's estimated right now, with the current number of people in forbearance, that over the next 6 months, it's essentially $30 billion in lost in revenue for mortgage servicers. So instead of being able to go and lend those $30 billion to consumers, they have to have that to be able to pay for those payments to the investors, the real estate taxes, and the insurance. So it causes a liquidity issue. Now, you're seeing that reflected on the rate sheets. What would typically be your rate for a consumer is going to be a little bit higher because of that risk that we see right now with the forbearance requests increasing, with the job losses increasing. But compared to where we were back in early March, the mortgage industry is getting healthier and healthier as time goes on. And we really can understand and know what those forbearance numbers are. So I hope that kind of just explains the forbearance issue and how it does cause a liquidity crisis in the mortgage industry.
And so, like you said before, you expect that over these next few weeks, there's going to be a lot of clarity around what the real forbearance rates are, because we're coming into May and people would have been making their May payments within the next few days.
Right. And really, I don't know the exact date, but I believe this was called a pandemic in early March. And so people probably already made their March mortgage payments. And then you had the April payments. And now we're only going into month 2. And this situation is kind of like running a marathon backwards. There's so much happening. We're trying to move forward and progress and get out of this crisis. But at the same time, we're trying to, make changes on the fly. And so the CARES Act, I understand, the reason why they did it. They didn't want people to worry about the mortgage payments. They didn't want them to worry about they have to go to work. They want everyone to stay home. Makes sense. Yeah. But what they didn't do is they didn't require that evidence of hardship. And so certainly there's a lot of people who are taking advantage of that. I wouldn't say a lot of people, but there are people, who could make the mortgage payments that aren't making the mortgage payments. And unfortunately for them, the information about how that's going to impact their ability to go get a new mortgage is still not clear. Right. And it should be, I think, over the next, week or two, there should be some guidance from Fannie Mae, Freddie Mac, and Ginnie Mae about that issue. And so once it comes out, we'll share it with you again.
Okay. So could we talk about how that liquidity issue impacts actual loan programs like FHA, jumbo? FHA is obviously a very common, loan program utilized by first-time buyers. And I know you and I have been back and forth over the last few weeks. If anybody was sitting on the listing side from a real estate perspective, if I have a seller who's under contract with a purchaser who was using an FHA loan, there was a period of time where FHA loans were very safe. There were nothing to shy away from if you're a seller. And a few weeks ago, I'm on the phone with you about how some of those changes with the certain loan programs were going to impact my clients who were already under contract if these loans couldn't actually close. So could we touch on that a little bit?
Sure. So what you have to understand is that when you're getting a mortgage loan, that mortgage bank is giving you the money, and with the assumption that you're going to be able to make the mortgage payments. And so when we're in a situation where we see the number of forbearance requests rising, we see the number of unemployment, first-time unemployment benefits rising, that means that there's a lot more risk for banks and lenders to go and lend. Now, FHA, VA, and all the other agencies haven't changed their guidelines. Okay, so they're still the same. What you're seeing change is banks and lenders add additional overlays to combat that risk of that person going into forbearance, of that person losing their job and not being able to make their mortgage payment. So they're tightening their credit availability, making it not more difficult to get a loan necessarily, but making it so they're giving loans to a more qualified individual or household. So you're seeing the credit score, minimum credit scores for FHA. Again, FHA didn't change anything, but banks and lenders are increasing their minimum credit scores. So those are things too that can change on the fly. Guidelines, lenders have the right to change, their requirements, anytime they wish. And so you could have someone, and we have received plenty of calls lately where you had someone who was pre-approved with another bank or lender, and that lender had changed their guidelines, and now their pre-approval is no longer valid. So they're coming to us asking what our minimum credit scores are, and if we're able to give them the loan at this time. And of course, we look at our current guidelines and issue the pre-approval letter if we're able to, but things can change. So you're seeing credit being restricted right now when people need it the most, and that is unfortunate, and that does come over time when the industry and gets a little bit healthier. You'll see that kind of go back to how it was, but this is the tightest credit has been since the housing recession in 2008.
And obviously that then spirals into things like refinances, cash out refinances, right?
Correct.
So
Correct.
in terms of what you're seeing with people's ability, both today and your projections over the next few months, cash out refinances almost going away?
Well, I wouldn't say, it depends. But the ability to tap into your home's equity is becoming more difficult, again, because of the forbearance requests. And so one thing to understand is, when you get a mortgage, you're typically getting a Fannie, Freddie, or Ginnie Mae product, unless you're doing a non-QM, which is a jumbo loan. And those loans are owned by Fannie, Freddie, and Ginnie Mae. And when you have those loans and they're not making mortgage payments, the servicer has to pay those. So what Ginnie Mae has done for if you have a VA, FHA, or USDA loan is they will front the servicers the funds so they can make those payments to the investors. But when it comes to your conventional products, Fannie Mae, Freddie Mac, the FHFA has not provided that same liquidity resolution that Ginnie Mae has. And so essentially what's happening is if you have someone who you give the loan, they don't make the first mortgage payment, they go into forbearance right away. Fannie Mae and Freddie Mac will purchase that loan from the servicer, but they're going to charge them 500 to 700 basis points, which, if you understand that, that's 5% to 7% of the loan. And that's for a purchase and a refinance. Now, when it's a cash out refinance, they will not purchase it. So if I was a bank or lender and understanding that, like if I have this person who I give this cash out refinance to, but they don't make mortgage payments, I may not necessarily want to give them that loan without charging them more. And you typically always have a higher interest rate once a cash out refinance in the first place. But now we're seeing different banks and lenders, and some of the largest in the country, charge that 500 to 700 basis points because you're doing a cash out refinance. So it could potentially become extremely expensive to tap into your home's equity. And that's unfortunate because we are in a position right now where people have the most equity in their homes than they ever have. And people need, that equity now more than ever, whether it's, to do a debt consolidation loan or to, you're in your house, you want to do some renovation work to it. It's becoming more and more difficult. So over time, it just, we don't know what the recovery is going to look like. We don't know how long this is going to last, but as of this moment in time, yes, it's becoming more difficult. Could become more difficult to do a cash out refinance.
Yeah, I can't remember the exact percentage, but I know I think it's something like 38% of Americans own their home free and clear. So a lot of those people in this situation, that's one of the reasons that the thought has been that the recovery is going to be so much different than recessions past, because people do have such an amazing equity position in their homes. So if they can't tap into that, or it's a lot harder or a lot more expensive, then yeah, the negative effect of that could be significant.
Well, it's unfortunate. I mean, it could be, it could change again pretty quickly. Right now, we're still able to do cash out refinances here at Highlands Residential Mortgage, but we'll just see how this unfolds.